Good morning and welcome. Whether you're just starting your day or catching up on the latest financial news, we're glad you're here. Today, we're diving into a topic that touches every single one of us: interest rates and the Federal Reserve's next big move. These decisions might sound distant or complicated, but they have a real impact on your daily life. You've probably heard talk about possible changes that could make borrowing for a car or house cheaper. Maybe you're wondering if now is the right time to buy, or if you should wait for rates to drop even further. We're here to break it all down in simple terms, so you can make sense of what's happening and how it affects your wallet, your savings, and your future plans. The Federal Reserve has kept rates steady for a while, but now, as we move through summer 2025, the conversation is shifting. People are asking, will rates finally come down? What does that mean for me? Wall Street and everyday investors alike are watching closely, expecting the Fed to cut rates soon, based on real economic clues. These clues come from everything from job reports to inflation numbers and even global events. Think of the economy as a car and the Fed as the driver. Sometimes it's time to hit the gas and sometimes it's time to tap the brakes. The choices they make can speed things up or slow them down for all of us. We'll look at the job market, stubborn prices, and how these factors shape the Fed's decisions. Are people finding work easily? Are wages keeping up with costs? Plus, we'll explore new government policies like tariffs, which can affect the prices of everyday goods and the overall economy. Our goal? To give you the knowledge and confidence you need to navigate your finances, make smart decisions, and feel prepared for whatever comes next. If you find this helpful, don't forget to subscribe to Tech Monetize Official for more updates, tips, and easy-to-understand breakdowns of the financial world. Let's dive in together and make sense of what's next for your money. Whether you're saving, investing, or just trying to keep up, we're here to help you every step of the way. Let's get started. Before we go further, let's clarify the main player here, the Federal Reserve, or the Fed. You've probably heard about it in the news, especially when there's talk of interest rates, inflation, or the economy. But what exactly does the Fed do, and why does it matter so much to your daily life? The Federal Reserve is the central bank of the United States. Its two main jobs are to keep prices stable, meaning controlling inflation, and to aim for maximum employment so as many people as possible have jobs. These goals are at the heart of the Fed's mission, and they guide every decision it makes. The Fed's most powerful tool is the federal funds rate. This is the interest rate that banks charge each other for overnight loans. It might sound like something that only matters to bankers, but it actually affects the entire economy. While you don't pay this rate directly, it acts like a domino, influencing all other interest rates in the economy, from the rates on your savings account to the interest you pay on loans and credit cards. When the Fed cuts rates, borrowing money gets cheaper for banks, which then pass those savings on to businesses and consumers. That means you might see lower rates on things like car loans, student loans, and mortgages, making it easier for people to buy homes, cars, or start new projects. Lower rates also mean you'll pay less interest on your credit cards and other debts. This encourages people to spend and invest, which helps the economy grow. On the flip side, if rates go up, borrowing becomes more expensive and people tend to spend less. If inflation starts rising too quickly, meaning prices for everyday goods and services are going up, the Fed can raise rates to slow things down. Higher rates make borrowing more expensive, which can help cool off inflation. The Federal Open Market Committee, or FOMC, is the group within the Fed that meets 8 times a year to decide whether to raise, lower, or hold interest rates steady. These meetings are closely watched by economists, investors, and policymakers around the world. The decisions made by the FOMC ripple through the global financial system. Stock markets, currencies, and even international trade can be affected, so everyone pays close attention to what the Fed says and does. Right now, the Fed has been holding rates steady, carefully watching economic data and signals from the market. They're looking for signs of inflation, job growth, and other trends before making their next move. It's a huge responsibility, with a massive impact on the economy, businesses, and families across the country. Every decision the Fed makes can affect your wallet, your job, and your future. That's why understanding the Fed's role isn't just for economists or Wall Street insiders. It's key to understanding your own finances and making smart decisions for your future. So let's dive in and see why everyone is expecting a change from the Fed and what it could mean for you. Why is a rate cut almost certain? It's a question on everyone's mind, from Wall Street traders to everyday investors and even small business owners. The answer lies in a mix of market signals, economic data, and the psychology of expectations. The market is sending strong signals, traders are watching every move, and financial charts are lighting up with predictions. Investors use tools like the CME Group's Fed Watch to bet on what the Fed will do. These tools aggregate market sentiment and turn it into probabilities, making it easier to see what the majority expects. Right now, there's a nearly 90% chance of a rate cut at the September 2025 meeting. That's not just a guess. It's a consensus built from millions of trades and countless data points. When expectations are this high, the Fed risks market turmoil if it doesn't act. Markets can react sharply to surprises, and the stakes are high for both investors and policymakers. This belief has built up over months, fueled by economic data showing the economy is slowing. Reports on consumer spending, manufacturing, and inflation all point to a cooling economy. The Fed's previous cuts in late 2024 were the first sign of concern. Those moves signaled that the central bank was ready to step in to support growth if needed. Now, new reports on jobs and growth suggest another cut is needed to keep things moving. Slower job creation and weaker business investment are adding to the pressure. Think of the Fed as a doctor. After an earlier dose of medicine, new symptoms mean it's time for another. The central bank's job is to keep the economy healthy, and sometimes that means adjusting the treatment. The market is waiting, and the anticipation is real. Every day without a decision adds to the tension, as investors try to predict the Fed's next move. Let's look at what's driving this urgency and why so many are convinced a rate cut is just around the corner. It's not just about one rate cut. Big banks now expect a series. JP Morgan, for example, recently shifted from predicting one cut to 4, starting in September 2025, and continuing into early 2026. This dramatic change signals a deeper economic slowdown than previously thought. When major institutions revise forecasts, it means the data has changed in a meaningful way. They see a weakening job market and other troubling trends, pushing the Fed to act more aggressively. These forecasts fuel market expectations and highlight why staying informed is crucial. If you want clear, simple explanations of financial news, subscribe to Tech Monetize Official. Let's explore the data behind these predictions. Here's what's worrying the experts. The job market is a big concern. July's jobs report was weaker than expected, and previous months' numbers were revised downward. Unemployment has ticked up, and continuing jobless claims are rising, signs it's getting harder to find work. The Fed's goal of maximum employment is at risk if this trend continues. At the same time, inflation remains stubbornly above the Fed's 2% target, with the latest reading at 2.8%. This puts the Fed in a tough spot cut rates to help jobs, or keep them high to fight inflation. Most analysts now believe the risk of recession outweighs inflation concerns. The Fed must decide which risk is greater, recession or persistent inflation. The next jobs report could be the tipping point. The stakes are high and the pressure is mounting. Let's add another layer: new tariffs. Here's how they complicate things. New tariffs are making the Fed's job even harder. Tariffs raise the cost of imported goods, which can push up prices and add to inflation. So far, many businesses have absorbed these costs. But if they start raising prices, inflation could rise further. Tariffs also create uncertainty, making businesses hesitant to invest or hire. This uncertainty can slow economic growth, even as the stock market stays strong. Some Fed officials argue tariffs won't have a major impact, while others worry about inflation. The Fed must weigh immediate economic needs against future risks from trade policy. It's a complex balancing act. Now let's look inside the Fed itself. The Fed isn't a single voice, it's a committee, and right now there's real disagreement. For most of the year, the committee was united in holding rates steady. But at the July meeting, two members, Governors Waller and Bowman, voted to cut rates immediately. A double dissent is rare and signals growing internal pressure to act. If more members join, it will be hard for the Fed to avoid a cut. The internal debate is shifting rapidly toward easing policy. Politics also play a role. President Trump's nominee, Stephen Moran, supports cutting rates and downplays tariff risks. The makeup of the board can influence policy direction. The Fed's credibility depends on consensus, but that's now in question. The pressure is building from both inside and outside. So what does all this mean for you? What does a rate cut mean for your finances? If the Fed cuts rates, borrowing gets cheaper, lower interest on car loans, mortgages, and credit cards. That could save you hundreds or thousands over time, or make refinancing more attractive. On the flip side, savers will see lower returns on savings accounts and CDs. It's a trade-off: easier borrowing, but less reward for saving. The stock market often reacts positively to rate cuts, as companies can borrow more cheaply and profits may rise. But much of the good news may already be priced in. Understanding these changes helps you make smarter financial decisions. Stay informed to take advantage of opportunities and avoid pitfalls. Let's wrap it all up. To sum up, the U.S. economy is at a turning point. The Federal Reserve is likely to cut rates soon, responding to a slowing job market and persistent inflation. New tariffs add uncertainty, and internal debate at the Fed is intensifying. Markets expect a series of cuts, not just one, as major banks revise their forecasts. For you, this means lower borrowing costs, but also lower returns on savings. The stock market may benefit, but risks remain. Understanding these shifts is key to making smart money moves. Thanks for joining us to break down this crucial topic. If you found this helpful, subscribe to Tech Monetize Official for more insights. We're here to help you navigate the world of finance with confidence. Stay informed, stay empowered. Until next time, take care of your money and your future. See you soon.